Capital Markets and Institutions. Module 1. Foundations of Capital Markets and Institutions. 1. Introduction to Financial Markets. When we talk about financial markets, we are essentially discussing the platforms, mechanisms, and environments where financial assets are created, bought, and sold. These markets are not limited to a physical space like a stock exchange building. They can also be electronic networks that connect buyers and sellers from all over the world. Financial markets serve a crucial role in the economy. They provide a way for surplus units, those who have excess funds, such as households or corporations with savings, to transfer their resources to deficit units, those who need funds, such as governments or businesses wanting to expand operations. This process is essential because it channels capital to the most productive uses. Without it, economic growth would be slower, and innovation would be stifled. The range of participants in financial markets is broad: individual investors, banks, insurance companies, pension funds, corporations, governments, and even supranational organizations like the World Bank. Each plays a unique role. For example, a pension fund invests for the long term to ensure retirement payouts, while a hedge fund may take shorter-term, higher-risk positions to maximize returns. Financial markets can be broadly classified into money markets and capital markets. Money markets deal with short-term funds, often for a year or less, and are used mainly for liquidity management. Capital markets, on the other hand, handle long-term securities, those with maturities greater than a year, and are used to fund investments in projects and operations that take time to yield results. In addition to this, there are also derivative markets, where instruments like options and futures are traded. These are designed to help manage financial risk, but they can also be used for speculation. The efficiency of a financial market depends on transparency, liquidity, and the existence of a strong regulatory framework. Without this, markets can be distorted by fraud, manipulation, and inefficiency, undermining their primary function of capital allocation. 2. Role of financial institutions in a market economy. Financial institutions are the lifeblood of any market economy. They are the intermediaries that ensure funds move smoothly between those who have them and those who need them. Imagine the economy as a circulatory system. Financial institutions are the arteries and veins through which the blood of capital flows. These institutions include commercial banks, investment banks, insurance companies, pension funds, mutual funds, credit unions, microfinance institutions, and development banks. While their business models differ, they share a common purpose: to connect capital suppliers and capital users. A commercial bank, for example, accepts deposits from customers, pays them interest, and then uses those funds to lend to borrowers at a higher interest rate. This process is not just about making money for the bank, it allows individuals to buy homes, entrepreneurs to start businesses, and companies to expand operations. Investment banks perform a different function. They help companies and governments raise funds by issuing stocks and bonds. They also provide advisory services for mergers and acquisitions, restructuring, and other complex financial transactions. Insurance companies play a protective role by pooling risks. People and businesses pay premiums, and in return, the insurer provides compensation in the event of loss. This helps businesses and individuals take on more economic activity without fear of catastrophic loss. Pension funds manage large pools of retirement savings and invest them to ensure that retirees receive steady income in their later years. Mutual funds pool money from many investors to invest in a diversified portfolio of securities, giving smaller investors access to professional management and diversification benefits. Financial institutions also contribute to the stability and growth of the economy by facilitating payments, providing credit, and helping manage risk. Without them, markets would be fragmented, inefficient, and prone to crisis. 3. Overview of the banking industry. The banking industry is one of the most critical components of the financial system. Banks act as intermediaries between depositors and borrowers, and their ability to transform short-term deposits into long-term loans is at the heart of modern finance. Commercial banks offer services such as accepting deposits, providing loans, facilitating payments, and offering basic investment products. In addition to traditional services, modern banks now offer online banking, mobile payment solutions, and digital asset services, reflecting the growing role of technology in finance. Banks are subject to strict regulations because they handle public funds and their failure can have severe economic consequences. Regulatory bodies, such as the Federal Reserve in the United States, the European Central Bank in the EU, and the Central Bank of Nigeria, set rules on capital adequacy, liquidity ratios, and lending practices to ensure stability. In many countries, banks are divided into categories such as retail banks, which focus on individuals and small businesses, corporate banks, which serve larger companies, and investment banks, which specialize in capital markets activities. Some banks are universal banks, offering all these services under one roof. The health of the banking industry is often seen as a reflection of the overall health of the economy. When banks are profitable and well capitalized, they can lend more, fueling economic growth. Conversely, a banking crisis can trigger recessions, as seen in the global financial crisis of 2008. 4. The Federal Reserve and central banking functions. Central banks, such as the Federal Reserve in the United States, play a pivotal role in the financial system. They are responsible for managing a country's money supply, controlling inflation, regulating interest rates, and ensuring the stability of the financial system. One of the main tools central banks use is monetary policy. By adjusting interest rates, they can influence borrowing and lending behavior. For example, lowering interest rates makes borrowing cheaper, which can stimulate investment and spending. Raising rates has the opposite effect, helping to control inflation. Central banks also act as lenders of last resort. In times of crisis, they provide emergency funding to financial institutions to prevent a total collapse of the financial system. They also oversee payment systems, manage foreign exchange reserves, and sometimes engage in quantitative easing, purchasing financial assets to inject liquidity into the economy. The independence of a central bank is critical. If political leaders could directly control monetary policy, they might be tempted to keep interest rates artificially low before elections, leading to inflation and long-term instability. 5. Understanding financial intermediaries. Financial intermediaries are the entities that sit between savers and borrowers. They reduce transaction costs, provide liquidity, and spread risk through diversification. If individuals had to directly find and negotiate with borrowers, the process would be time-consuming, risky, and inefficient. Intermediaries handle this process by collecting funds from many savers and lending them to a variety of borrowers. They also provide maturity transformation, turning short-term liabilities like deposits into long-term assets like loans. This function allows businesses to make long-term investments while still giving savers access to their funds when needed. Another key function is risk management. By pooling funds and investing in a range of assets, intermediaries reduce the impact of a single borrower defaulting. They also offer financial products like insurance, derivatives, and mutual funds that allow individuals and businesses to manage specific risks.